understand the reaction here. See, this is the British election results are coming in live, okay, as we speak. So what it shows is clearly the exit polls are indicating a very strong majority for the Tory party, which is the Conservative party. So historically, the two big parties have been Conservatives and Labour. Okay, Conservatives are called Tories. So now they are coming, and that's this existing Prime Minister, current Prime Minister Boris Johnson, who's a Tory Prime Minister. He had actually he has positioned himself as a pro-Brexit candidate, and the Labour guys are actually anti-Brexit. Okay, they want to reverse Brexit. So that's the broad positioning. Although they're actually, if you look at the treaty that Boris Johnson has agreed with the EU, they're actually, it's not a clean Brexit. It's quite a messy Brexit. So it's not a very clean Brexit, which is what people voted for in the referendum. Okay, I guess. So even though that is the case, the election was clearly, generally people they can't appreciate all these nuances. So electorate votes on simple points. So Johnson was seen as pro-Brexit, the Tories were pro-Brexit, and the Labour was anti-Brexit. So the strong win for the Tories is a vote in favor of Brexit. Okay, and as a result of that, what you're seeing is cable is rising. Okay, if you look at Euro sterling is also, if you see the magnitude of the rise in cable. Okay, some of the connection has come back. So you can see here for this time of day, cable is pretty active actually, and this thing is it's moving around quite a bit. Okay, for this time, this is a very odd time because it's Asian time. Okay, nobody has come in. Zurich has not even come in, so there is no liquidity, and in general it's not supposed to be so liquid, but it's much more active because this election results are coming in and you're seeing the move. Just to give you an idea of how dramatic the move is in the cable, here you can see this this palette display that I have. You can see how dramatic this move is.
Yes, sir.
On the 5-minute charts, you can see it has pretty much moved from about 200 from 130.60 to 134.60. So about 400 points. Okay, very big move for this time of day for cable. This is reacting to the election results. Now I'll just show you one more thing. If you remember what I showed you, when I explained non-stationarity. Remember the term non-stationarity? When I pulled up a chart of crude oil prices and I showed you how the behavior of crude oil prices changed dramatically.
Yes.
Right? You remember that? Okay, so what I'm trying to show you here is part of the reason for that is you can see how dramatically the midpoint is shifting. The market is moving around. So what is this thing is called? This full thing is the full market depth. This is the full market depth. Okay, and the best bid and offer is, this is the top of the book, right? This is actually what a book looks like on an exchange server, where everybody's putting in their orders, bids and offers. The full depth of the market book you can see. So normally exchanges, what they do is they'll give you this data maybe for free, or they'll charge you maybe $10 for this data. But if you want to see the full book, they'll charge you maybe $20. So they have tiered pricing for different levels of information. So you can see this moving around. Now let's talk about why this once again proves. So what I had shown you is, if we go back to the crude oil prices, if I just briefly go back to the crude oil prices, this is similar to that, the similar idea. What makes markets so unpredictable? Because the market keeps shifting around and it's very difficult to predict. Alright, so here what we had shown you is how for almost 20 years this market had been fairly stable, very narrow trading range. Can you see there are two distinct phases in the crude oil chart? At least two distinct phases. We may be going into a different phase once again from this. So you can see here it was very tightly controlled, very little volatility. Okay, and the Saudis were complaining all the time that the oil price is very low, but they couldn't do anything, because even though at that time there was no US shale output, the US was not a dominant player in the oil markets. Okay, it was only the Russians and the South and OPEC, right? So all the Arab countries plus Venezuela, but they couldn't do anything with all their crying and complaining. They couldn't do anything to influence the oil price. That's how big the market is. And then suddenly you see that the price movement changes dramatically. So this is what essentially, if you want to visually remember what non-stationarity is, you'll remember this chart because pictures are easier to remember. Okay, this is a real chart. I didn't make it up. Okay, this is real data. So you can see how, can you see the qualitatively different nature of the movement between this phase and this phase? When it goes up here like this and comes down all the way till here, you can see. Okay, even here, can you see that the nature of the movement is quite different qualitatively? It's much more volatile. Can you see that? Yes. No, I'm not getting strong responses. Yes, yes, yes. So you have to, the movement is much more volatile. Can you see that? Right? The phase has changed. It's like, it's almost like you're looking at a different animal, right? So this is what happens in the market. This is what non-stationarity essentially means visually. Okay, that essentially the whole nature of market movement will suddenly get destabilized and it will move into a new regime. So this is called a regime change. It's like it's moving from here to one regime, which was a very, very quiet, low vol period, and then suddenly it moves into a new regime, which is a very high vol period. So that's what makes market, and you have no way of knowing when this is going to happen, when this regime change is going to happen. This is actually, in statistical parlance, it's called a regime change. When you study non-stationarity, when a market, the nature of the distribution changes, the statistical parameters change dramatically. Okay, the SD and all that changes dramatically. That's called a regime change, and you have no way of knowing when this is going to come. Okay, today we know it because we are looking at the past, but when you're doing predictive modeling for the future, you have no way of knowing when this is going to happen. Okay, so this is what makes, and if you look at economic data, also you will get the same phenomena. If you look at different degrees of movement, you will always get the same phenomena. You'll see suddenly that markets change. So now let's go back to the cable. We'll just only look at the cable, but I'll show you. Let's look at the cable and first give you an example for why I'm saying this is. Let's look at a daily chart. Now you see what makes markets so difficult to predict. Okay, now look at this. What is this movement? What do you think? What is it? This is 23rd June 2016, around mid-June 2016, late June 2016. What do you think? Is there any major event that would have caused this drop? June 2016, what happened? That was the Brexit referendum. Okay, so the point I'm trying to illustrate here is you see how dramatically markets change. Okay, it's as if you have an equation and suddenly you have a model with an equation, and suddenly what somebody does is, let's say it's a model with one exogenous variable, okay, in this case that's Brexit, and on the endogenous side you have the movement of the directional movement of the cable. Okay, if you imagine a model like that, it's as if what I'm going to show you is as if somebody has suddenly gone and put a minus sign before the exogenous variable, changed the impact completely around. Okay, so if you see what happened here, initially the perception of the market was around the time that the Brexit referendum happened, and even after that for many years actually, that the market's perception was that Brexit was bad for the pound, that Brexit was bad for the UK economy. You see everybody was doing fear mongering. You remember that? I don't know if you're following the debate. Even the governor of the Bank of England was engaging in a lot of fear mongering. Don't vote for Brexit because it's going to cause a disaster, economic disaster and all that, if the UK moves away from the EU. So that's why if you see, and when this is the top of the market, this is the Brexit referendum, and then it crashed after the referendum came in for Brexit, pro-Brexit vote, right? Then it crashed again here. If you see the low that is being made here, you're not able to see it because this thing. Okay, now if you see, I'm not going to go there because it will come and show us this low that I'm trying to show you, the lowest point on the chart, around September 2016. This low was actually made in very early morning Asian trading in this kind of illiquid situation. Okay, what we have now, you see once again it has gone down, right? 58.5 is the price. So this, you have to keep moving this to be able to see the top of the book along with the market depth, nearby market depth. So in early Asian time this drop happened. Why did this drop happen? Because Theresa May, who was then the Prime Minister, she made some statements. You know the discussion about the hard Brexit and the soft Brexit?
Deal and no deal. There is a deal Brexit and no deal Brexit.
Yeah, so the no deal Brexit is basically referred to as a hard Brexit, which means the UK just tells the EU to get lost and they just get out of the EU with no agreement as such. Okay, in this case Boris Johnson has negotiated an agreement, but that came later. So at this point Theresa May made some statements which were misinterpreted, I think, slightly, to indicate that she was in favor of a no deal Brexit, which is a hard Brexit, which is basically quite an acrimonious, it's like an acrimonious divorce, right, rather than an amicable settlement. So therefore, again, the market at this point, the market was again looking at Brexit as being bad for the UK, bad for the pound. Okay, because if you see a hard Brexit, that means it's like a pure form of Brexit. So that was seen as bad for the pound. So they sold off the pound in early Asian trading, and there was a lot of liquidity problems also. So actually, we don't even know what the exact traded low was over at this point because it was very, very hectic. Okay, so this is what is happening. Okay, so by and large, up until here, the market was behaving in the same way that up until very recently, till about this time, the market was behaving in the same way that whenever there was any news showing that Brexit was more likely, a no-deal Brexit was more likely, the pound would be sold off, and whenever there was supposed to be a reversal of Brexit, there's a chance of a reversal of Brexit, the pound would appreciate. Is that right? Are you following? Okay, so the psychology of the market was that Brexit is bad for the pound and the UK, and no deal and reversing Brexit is good. Okay, so that's why that. But now suddenly you see, as Boris Johnson's polls started getting favorable, suddenly around this time the behavior of the market changes. Okay, that if now because Boris Johnson was pushing for a Brexit, although not really a hard Brexit, so he was pushing for this, and now the market behavior was starting to change. And if you see what happens here, if you go back to this, you see you can see the full impact. You can see how important this high is. This is a high that can be seen even on the weekly charts. This high has been broken. Can you see that? By this dramatic move after the election. So as they see the Tories gaining a majority, and Boris is seen as pro-Brexit, whereas Labour is anti-Brexit. So this is seen as a vote in favour of Brexit, this election. It's a very strong majority that they're likely to get. Okay, historic kind of majority. So therefore the market is now buying the pound. Can you see how the market's behavior has totally changed? The input is the same. It's as if somebody went into the model and put in a minus sign before the exogenous variable, which is the probability of a hard Brexit. Okay, so earlier it was negative for the pound. Now this probability of a Brexit, okay, Brexit moving away from the EU, this is now seen as good for the pound. Are you able to follow this? And if you listen to the market commentary, I can also tell you what the market is going to say, how they're going to explain it, because the market experts are very good at explaining things after they've happened. Okay, there's always an explanation, because nobody wants to be caught saying that I don't know why this happened. No one's ever going to say that. Okay, unless you're a pure technician, in which case you say that I really don't think anybody knows why this happened. Okay, which is, I think, is the correct assessment, that no one really knows why this happens. That people keep talking like this because they can't accept the fact that they don't know why it happened. Okay, are you following what I'm saying, or is it all going over your head? Okay, so the way, if you listen to the market commentary without listening to the commentary, I can tell you how the market is going to interpret this. They're going to say now this is positive. The market is seeing this as positive for the sterling because it brings certainty. Because the market, the other theme that you will see is that the market is not supposed to like uncertainty. Okay, so if you see how dramatically the market is appreciated, if you see here, if you see the changes, percentage changes, you can see from the previous day. So cable is down. So here you can see cable is up about 2.2% overnight, which is quite a big move. All right, and euro sterling is down. So this means a stronger cable, stronger sterling. Is everyone clear about that? Yes, others, you're clear that euro sterling falling means stronger sterling. Why? I'm confused. Cable going up, I can understand, is stronger sterling, but euro sterling falling, why is it stronger sterling? Can you explain? You're nodding your head, but you're not able to explain. Yes, who is going to explain? Anjum, can you explain? I'm confused. Cable going up 2.2% is stronger sterling. Euro sterling falling 1.77%. Why is that stronger sterling? Can you explain? Is my question clear? Yes. Very simple explanation. Yes, Anjum, you're also not clear. Your WhatsApp does not give any answer. Okay. What is your? Who else is going to answer? Yeah. What is it?
So sterling is getting stronger. That means euro is getting weaker, and the price was falling down. That's why the sterling was strong, because the price of the euro was going down. Okay, good. Yeah. So your articulation can be improved, but you have understood the point. The point that she's making is that it's very simple. In euro sterling, what is the base currency? Euro. Okay. So when we say minus 1.77, that means we are referring to this rate. That means 1 euro is buying 1.77 less sterling. That means the euro is getting weak. If the base asset is dropping, so whenever these numbers are shown, they are shown for the base asset. So if the base asset is dropping, that means the terms asset is rising, and here the terms asset is sterling. Okay, so that Parul's answer is correct. Okay, but you have to improve your articulation.
But your logic is correct. Okay, so now you can see how the sterling is appreciating as both. Okay, both the euro and the sterling. These are important points. Okay, now, so this to understand now, you can see how dramatically, so this is what I want to illustrate, that this is something else you'll learn about markets, that the same discussion, the same point, the reaction of the market has completely turned around 180 degrees. Okay, over a period of time, suddenly the assessment of the market has totally turned around. Okay, this will be explained as being because of a removal of uncertainty. Now you have certainty, there's a clear mandate. Okay, because Theresa May also called an election earlier around this time, and that time she didn't get a very clean majority, and the market started dropping, etc. So there was, and she was also not at all in favor of a clean break, of a strong Brexit. So there were all these problems. Okay, so this is just a discussion of these points. I'll just show you the brief. I'll just briefly show you the euro sterling movement, so you can also appreciate that. Okay, is this a useful discussion? You're learning, not a very strong affirmative, not a very affirmative assessment. Okay, so you can see how dramatic the move in euro sterling already had started falling. Okay, and it's broken, and you can see here euro sterling has broken a pretty important support, because this is the highest low. This high has been exceeded by this high. So this was the highest high. So a very long uptrend on the daily charts has actually been broken. This high exceeds, so this is the highest high from here, and this is the highest low from which the new high was made, and that has now been broken. It was already broken before this. Okay, so you can see how this dramatic move, how the move is on the euro sterling as well. So sterling, so now the market sees this as a good thing for sterling. So we'll close the order books. We'll close the euro sterling order book, and we may come back to this later on at a later time. All right, so now we go back to our discussion of, maybe we can close this also at this point. We're not going to discuss this anymore. All right, so let's go back to our discussion of the case, what we were discussing. I'll just show you one more thing. What I was showing you to complete our discussion of euro dollar futures. We'll actually have to do a little bit more on that. Okay, so if you remember here, this is 1986. This data series starts from 1986. I was telling you that the euro dollar three-month LIBOR, okay, which is the underlying asset for the 3-month euro dollar futures contract that you see here. Okay, this is your GE, right? This is your 3-month euro dollar futures. Okay, for this, the underlying asset is 3-month US dollar LIBOR. Okay, the cash market deposits in London. All right, so this is the rate over here, the 3-month US dollar LIBOR. But because this is a short-term interest rate, this is a 3-month interest rate. It's an offshore dollar interest rate. Okay, it's not a US based interest rate. It's an offshore rate based on dollar deposits in London. Okay, and I wanted to just show you the connection, because I mentioned it to you the other day, but I didn't show you the other chart, which is here, which is, if you see the effective federal funds rate, which is the overnight rate for, basically this is the equivalent of our repo rate. In India, if you look at the policy rate, if you're asking about the interest rate, what is the main monetary policy rate in India? The answer is the repo rate, right? So here, the equivalent of the repo rate in India, the US equivalent is the effective federal funds rate, which is basically a volume weighted average of rates. Now there's one difference here. The repo rate involves borrowings from the Reserve Bank of India, okay, whereas this effective federal funds rate reflects borrowings between the banks in the interbank money market. Okay, but it's the same kind of, it's the equivalent policy rate. This is what the Federal Reserve targets, the central bank. You guys have done monetary policy, operation of monetary policy. Have you guys done it? Monetary policy transmission, open market operations, when the government pumps in money by buying securities, by doing repos and reverse repos. You haven't done all this?
Yes, sir.
Repos, reverse repos, you don't know all this? That if I'm doing a transaction with Kanika, if it's a repo for me, then it's a reverse repo for her.
Yes, sir.
Okay. So here, what will happen, if Kanika is borrowing money, she will, this transaction has 2 legs. Okay, so in the first leg of the transaction, it's a repo for her. So first, that's why it's a repo, because she agrees to repurchase the securities later. So in the first leg of the transaction, she sells me the securities, so I sell her money. since I buy the securities and she's selling the government's the debt securities, all right? So I'm buying the debt security, she's selling the debt security. So if I'm buying debt securities, I'm selling money, right? So she gets the money. So this is a form of secured lending. You haven't done all these transactions. Repo, you've done repos, right? You know the structure. So repo and reverse repo is just like one person's, depending on whose perspective it is. So in this case, it's a repo for her and it's a reverse repo for me. It's a repo for her because she agrees as part of the transaction. This transaction is not complete. It has two legs. So if it's a 3-month borrowing, usually these money market repos are quite short term. Usually it's about overnight. Overnight is very active, and then it's up to about 14 days or so. All right. So then what will happen is she will agree after 14 days. She agrees that she will buy back the security she sold me. Right. And suppose she sold me the securities at $100 a piece in the first leg. Then she'll buy back the securities at $105 a leg. I'm just giving an example. When she buys back the securities after 14 days, I'm just giving a crude example with very large differences in numbers. So she will buy back at $105 a piece, okay, at per bond. She'll buy back at $105. Now what will happen? So that $5 extra that I'm making, because I'm buying at $100 on the first leg, okay, and I'm selling at, maybe we should do this on the, so do a repo transaction. We should do this, I think, because I don't think everybody understands clearly. Is that correct? You understand clearly? Everyone understands clearly repo transaction, how it works. Okay, let's try and do it one more time just to be on the safe. I'm not getting confident responses. When I look at people's faces, I'm not getting confident responses. Okay, we'll try and do this here once again. Okay, so what is happening is, say, okay, so the party ones, let's look at party one's thing. What is happening is minus 100, okay, and on the plus side you have, in this case she gets plus 100, okay, so let's just draw it as 100, and then she gets minus bonds, okay, we'll just write it like this. So what party one is doing, this is the party for whom it's a repo. This party is a repo, and let's say this is party 2, and for party 2 it's a reverse repo. Okay, yes, so this is a reverse repo for this party. Same transaction, looked at from one person's point of view is repo, another person's point of view is reverse repo. Okay, so what is happening? This is party 2. Okay, so in India this would be the central bank. All right, now what happens here for this party wants to borrow, right? This is secured borrowing. It's a form of secured borrowing. We also call it collateralized borrowing. Okay, so this party will get 100 rupees, okay, $100, and it will sell the bonds. Okay. And this party obviously will buy the bonds. This will buy the bonds. Okay, now we can't write or put a comma here. Okay, so it will buy the bonds and it will sell the money. Okay. It will sell the money. Okay, so it's buying bonds and selling money. After 14 days, the transactions are reversed. This is a 14-day repo, right? So the transactions are reversed after 14 days. Now, of course, the prices are going to be different. We're going to change the prices. All right. So what is going to happen is, this is the price that she's going to pay for the borrowing. She's now going to pay $105. This is a crude example, just to create a big difference between the numbers. Okay. Now what is happening? So what is this clear now, the transaction? So the bonds position is squared. Everybody's bond position is squared. Plus bonds minus bonds. The bond is only acting as collateral. Right? So now here, let's call this guy the borrower. And this is called the lender. Right? So we'll put this into one box. So we'll call this, we'll make this a box. We'll give it a nice color which stands out. Alright, and we will call this repo as secured lending. Right? When I say repo, obviously it includes reverse repo also. Okay, so repo is secured lending, and we're gonna just okay. So this is your display. Now, what is the interest cost? 5 is the interest cost. Okay. So let's call this. We are going to give this another set of names. We are going to use these names later as well. Near date. No, this is the near date. We are going to use these terms later on in future spreads also. We are going to call this near date. This is all being put into your spreadsheet. Okay, so near date and far date, these are the terms we are going to use, because there are a couple of other transactions which are structurally identical to a repo transaction, which is a foreign exchange swap. When we do a foreign exchange swap, when we get into the module on swaps, a foreign exchange swap is structurally absolutely identical to a repo transaction. All right, there's also an interest component in that. So and the only thing is, instead of doing bonds and money, you're doing money and money, because it's an FX transactions. Both the assets are money. So yen and sterling, dollar and Aussie, okay, USD and Aussie, whatever, Canadian and Japanese, but both are going to be, so one bond is going to get replaced, one is going to become a currency. So FX swap is structurally identical to a repo transaction, and there's another thing which is a future spread, an inter-month future spread. That's also, we're going to study that structure. They are all three are identical structurally. The transactions are all identical. So it's very important that you understand, because repo is a very basic monetary policy tool. I don't think everybody understood it clearly. Okay, so I think it's useful that we have this discussion to make sure that everybody understands clearly. 105. So 5 is the interest cost. Okay, so here Kanika is borrowing $100, okay, by paying $5 for interest cost for whatever the repo period is. Okay, so this is how the system works. Okay, you pay back the interest instead of giving an explicit interest, you buy back the bonds at a higher price, and that's the interest that you're paying. Is everyone clear? Everyone 100% clear about the repo structure? Ritesh, you're clear? Alright. So this is a very important type of transaction to understand. This is the repo transaction, and how this is our repo rate is our policy rate. Yeah. Give her the mic.
Sir?
Yes.
So my question is, sir, in both the cases, the lender is in profit.
Yeah, so lender is in profit in the sense, when I'm lending you money, I need to get interest, right?
But sir, we have studied that reverse repo rate is when RBI wants funds from banks. They
see, remember, 1 minute. Remember that repo for the borrower. Okay, repo is for the borrower. Why? Because the repo comes from the word, these are actually, the full term is repurchase agreements. Okay, let's use the same full term. Repo name comes from, I don't know if you knew this also, this comes from, this is the US, again, most of these developments are, the proper name is repurchase agreements. Okay, repo comes from repurchase agreement. So why is it a repurchase agreement? Because here Kanika is agreeing to repurchase the bonds at $105 a piece. Okay, she's selling it and she's agreeing to repurchase at $105 a piece. Okay, so you can also say that even from my points it's a repurchase because she's agreed to repurchase. You can say that also. But the main thing to understand is basically this: who is selling the in the case of a repo transaction. Okay, in the case of a repo transaction, there's only one currency flow happening. So who's getting the currency inflow in the beginning and in the near leg? On the near leg, this is also called the near leg. There are two legs to this transaction. This transaction has near legs, and let's call this also, let's use this term also, leg. Okay, this is also a leg. So it's standing on two legs, this transaction. Alright, so near leg, who is getting the money, who's getting the cash inflow in the near leg? That you have to identify. Okay, that person is the borrower. Yes? Everyone's clear? Okay, so one side is the bond, one side is cash. So whoever's getting the cash inflow on the near leg is the borrower. And it's a profit obviously, because the person who's lending you money is going to demand interest. He's not going to lend money free of charge.
So that's what I'm saying. According to that, borrower should come above 105 on the other side. It is confusing.
No, I didn't understand.
In first,
On this side.
I understood, but I think you say that in first case, when there's 100.
Party 1.
Yeah. No. Let it be.
That's a Beatles song actually. Let it be. Yeah.
Like in first case, when there's 100 inflow and bonds are going out. In that case, borrower, you have written borrower is right. But in the second case, you should write borrower on the other side and the lender on the this side. Because otherwise it is confusing.
You're talking about here.
Yes, I get
Here. Here I should write borrower to show this.
Yes, sir.
Okay, but this is not actually borrowing. This money that is coming back to me is my P plus I. This is my P plus I. I am the lender. The P plus I has to come back to me. When you put a fixed deposit at Axis Bank, at the end of 3 months, the P plus I has to come back to you. Right? So we don't call you a borrower because the P plus I is coming back to you after the end of the loan period. We don't call you a borrower. You are still a lender. You are getting the P plus I back. Here this is P. This inflow to the borrower is only P. And at the end of the lending transaction, when the money comes back to the lender, this is P plus I. Right? So therefore we should not call them a lender. Okay? But good, this is what you should do. Any confusion that you have, you should ask the question so that you can clear your understanding. Okay? Otherwise what happens, oh, you don't understand. Okay, I forget, no problem. I just relax. And then after 3-4 sessions, you don't know what is happening in the class. Yes, Anjum also has this is a great day. I think we should all clap. Anjum has a question. Yes. Suddenly she has woken up from her WhatsApp and she is doing asking. Okay, ask. Yes. Yes. Okay, quiet. Let's hear.
I'm agreeing with Parul and she's right that you should write reverse repo in borrower on the second transaction because on the second case even the repo one will get P plus I.
You're talking about this side. This side.
Yes, in the second case.
Here.
Yes. So I'm actually agreeing with Parul.
No, but Parul has already withdrawn her objection. So now you're no longer agreeing with Parul, you are coming up with a similar objection. Because she has already withdrawn her objection. Now she has understood why I'm not calling that person a borrower. Why I'm not calling P2 a borrower? Because the money that P2 is getting back is P plus I. That is what a lender gets back at the end of the loan period. Yes.
Second transaction.
Which? Okay, 1 minute. She is saying second transaction. There is no second transaction. Second leg. Second leg or far date. Either you say far leg or second leg, or you say far date.
According to reverse repo, the lender will be the borrower.
No, I don't know what definition you have. You can look at it from either side. Okay, I look at it from the side that basically when you are borrowing, okay, because it's from the perspective of the person who's getting the money inflow. Okay, you call this a repo and you call this is how traditionally it's defined. Okay, so but the point here is always that reverse repo and repo are always it depends on whose perspective you take, right? Whether you take the borrower's perspective or the lender's. It's more important to be clear about who's the borrower and who's the lender. And the borrower is the person who is experiencing the cash inflow on the near leg. This is clear. That is more important to be clear about than who's borrowing. Okay, and who then therefore you figure out the interest rate based on the cash inflow that is happening to the lender at the end on the far leg. This is clear? Okay, so repo and reverse repo depends on your perspective. Okay. Alright, so it comes from the word repurchase agreement because the person who's selling the securities, agrees to repurchase the securities. Okay, so it's a security sale with a repurchase agreement attached to it. So it is one transaction. It is not treated as two transactions. One transaction with two legs. Okay, alright. So this is our repo transaction example. Okay, so here we're talking about policy rates. Okay, so repo is a form of borrowing very common in money markets. When the central banks conduct money market, open market operations, you've heard of? Open market operations, these are all conducted through repos and reverse repos. Okay, so in future we'll just say repos. We're not going to use the same, but it's the same thing. Okay, so they are all conducted through, whether it's in the US or in India, they are conducted through open market operations, through repo transactions, by adding and draining funds. All right, so how the Federal Reserve keeps this is the money market rate, the benchmark money market rate in the US. This you can see again, you remember we talked about cyclicality. This again, I didn't cook up this data. This data is real data from 1955. You can see the effective federal funds rate. This is the rate at which banks in New York have been borrowing federal funds, which is basically reserve funds. You understand what reserve bank funds are?
Yes.
We showed you that concentric circles, remember? That you have the central bank in the middle, which is there in every country pretty much, all the Anglo-Saxon countries. Even the non-Anglo-Saxon countries have the system. Most modern economies have the system. Central bank in the middle. First circle is all the commercial banks who are connected. In India, we call them scheduled commercial banks. And then the second circle is all the customers, the natural persons and the artificial persons who have accounts with the central bank, with the commercial banks. Is this clear? The system. So this is the rate for commercial banks borrowing from each other. And what the Federal Reserve does is they try to keep this within a Fed funds target range. When the policy meetings happen in the Federal Reserve, like we had one just a couple of days ago. Okay, they kept the rates unchanged. So they have a range for the Fed funds rate. What the US Federal Reserve targets, unlike our Reserve Bank, which targets a repo rate. Okay, the Federal Reserve targets the interbank money market borrowing rate. Okay, borrowing and lending rate. This is called the Fed funds rate, or the effective federal funds rate. Okay, so when the Federal Reserve is setting up policy decisions, they are deciding to target a particular range for the Fed funds rate, which is basically keeping money market rates in a particular range. They don't want to let it get out of hand. So if it gets too high, then they will add funds through open market operations. If it gets too low, then they will drain funds through open market operations. And open market operations you already know now, okay, through repo transactions. Is everyone clear about this? So it's very important to the US is the most important economy in the world, and it will remain so in your lifetime also. I don't see anybody overtaking them. Forget about my lifetime. Even in your lifetime, no one's going to overtake them. Okay. So unless they get some real hardcore socialist candidates who take the country in a leftward direction, otherwise the US will remain dominant. Okay. Nobody's even close. So now, very important to understand the operation of US capital markets, okay, and the whole financial system in the US. So this is the federal funds rate. You can see, also notice the cyclicality. Can you see how almost perfectly cyclical movement in interest rates? Okay, and these are all real data. Okay, and you can see here all the stuff we studied, higher highs, higher lows, and then if you zoom in, you see the same pattern of higher highs and higher lows at multiple degrees of movement. Can you see that? We don't have multiple time frame charts, but you can already see it here itself. Like this is a big down here, but within this big down you can see down, up, down, up, down, up, down. It's an up and down again. You can see, if you zoom into this part, you can see all the same patterns again. Is this clear? You can see it everywhere. Economic data, financial asset price data, everywhere you'll see this phenomenon. Cyclicality, and then this pattern of uptrends and downtrends. Okay, you'll see this everywhere. So once again, you can see from 1986 onwards, if you look at it, from 1986, around this 1986, around here, okay. So from here, if you look at this pattern here, this pattern, you can see it reflected here also. Can you see this? Same pattern. Two different interest rates. Okay, this is basically an overnight interest rate, but see how similar the pattern is from 1986. Okay, same kind of pattern here. Same pattern, but this looks much more zoomed in because that's all the data that this particular series has. Are you following? So the point I'm just visually proving to you once again the statement that I made the other day, that is that the 3-month London Interbank of the 3-month LIBOR rate will track very closely the effective federal funds rate, which is the Fed funds policy rate, because that's a very short term rate, overnight to 14 days, and so a 3-month rate can't be too far out of line with the 14-day interest rate. This is clear. So you have, if you wanted to take a longer view on LIBOR, because you don't have, let's say, so one of the workarounds you have is, these two will track fairly closely. So if you get into a situation like this where your LIBOR database is only up to 1986, but your Fed funds database goes much further back to 1955, so you can use the big swings on the Fed funds in a chart to basically proxy the implied swings in LIBOR. You can assume that the long-term LIBOR chart would also look pretty much like this. Okay, are you following what I'm saying? Okay, so it's a proxy. So this is for our euro-dollar discussion that we already completed the other day. Okay, now I just want to go back. This is already there. Everyone on board so far? Any questions? Yes? Give him some water. I think he's struggling. Okay. Where did we have this? Okay, guys, one more thing. Okay, let's go back now. Let's go back to our discussion where we have green. Okay, so this should be again another. Maybe we can make it a little bit lighter, and we'll just have another. Okay, let me explain one more thing here. We need to put in one more, right? We'll put it here. All right. Okay. So let's see if we can shift these cells down. It should be insert, right? Insert cells and shift down. Does it work without? Okay, all right, okay. So we won't do that, we'll do it here. Okay, so let's make sure we understand one thing here. I've already explained this towards the end of the video yesterday, because after the class, Saloni was asking a question and she was not clear about how the underlying position changes, how the total position changes as a result of your hedges. So let's quickly run through that once again. Okay, so your underlying position is, this is the total, okay? This is the total of your underlying position and hedge positions. What is this? Okay, this is all the underlying positions here, and this is all the hedge positions here. We're not going to change the underlying position. Okay, all right, so understand this here first. So you first start with now we are going back to your case. We're going back to your case and just trying to confirm very quickly, just trying to confirm that we understand what is going on. Why because now you'll have to start thinking in terms of you already walk into the room, you walk in with the underlying positions. That's why it's a passive risk book. Okay, the risks are already there. Now you have to manage a hedge book in such a way that your total losses are minimized or your total profits are maximized, whatever way you want to look at it, right? So you have to manage the total, you can't touch the underlying positions. So you have to take a view on the KRF markets, and being conscious of your underlying positions in the KRF markets, you have to therefore accordingly take action, either do nothing or buy or sell as a hedge. Okay, you will have to create hedge positions so that the goal is the hedge position should offset the losses on the underlying position, so that your total losses are minimized. Okay, and so let's look at the idea of how the positions work. Let's look at how, just be clear about that. Okay, you can play around with this on your own. So you start out with 20, when we're looking at the oil positions, you start out with 25 contracts long, because the oil position is 25,000 barrels, so that's 25 contracts long. All right, so this is in your calc sheet. Okay, in the futures, all this is happening in the futures, so maybe I should rename the sheet as magma, because that will give you the connection that this is for this particular case, all the discussions that we are having here on this point. So you start out with the underlying position of 25. So let's say you sell 3 contracts. What happens to your underlying position? Your total position, this is your total position. Okay, is everyone following this? We can put this here, I think. We don't want to put anything else here. Total position, all right. Is everyone following here? Underlying, okay, this is already written here actually. I didn't need to put this. We can put this here. All right. Hedge position, underlying position, everybody understands, and that's your total position. All right. So you had initially your underlying position, your total position was 25 long plus 25. Then you sold three contracts in your hedge book. Okay. So your net position now becomes total position, net total position is 22. Is everyone clear about that? Okay, now let's say what happens is, suppose you sold, let's make this a little bit bigger, let's make it like 10 contracts so we can see a clear contrast. So you sold 10 contracts. Why did you sell 10 contracts? Because you had, now we are trying to understand the impact of, what we are trying to understand is basically continuing from yesterday's discussion. We are trying to confirm for you once again why an active or a dynamic hedging program, let's use the word dynamic and static, why a dynamic hedging program is more risky. Okay, why is it more risky? What happens? Okay, so let's understand this. So you're running a dynamic hedging program. Now you initially sold 10 contracts because you looked at the oil chart. Let's go back to US oil. You looked at the oil chart and you came to a view that this thing was going to drop. Okay, and let's make this a little bit smaller so we can have a little bit more granularity. Okay, you are looking at this now. All right, so you sold 10 contracts here because you thought that in a very short term, playing very short term moves, you thought that this is going to come down to say 57. Okay, so at 59.45 you sold 10 contracts because you are taking very short term views and you think that this is going to come down to 57. Okay, so you want to basically at least hedge a little bit of your exposure because your exposure is long 25 contracts, so you want to hedge a little bit, so you sell 10 contracts on the hedge book. Yes, everyone's following? Okay, now your view turns out to be correct. The market falls from 59.45 to 57. Okay, but that's the extent that of the decline that you expected. You don't expect this to break. You expect this to eventually again rise back to 62. So let's say if you form these kinds of clear, intricate views. So this gives you an idea of how you have to take views in markets. You have to take very precise views, not the kind of global, you see when you listen to experts on TV, they talk in very global language, and they're not very precise at all. But in real life, when you're actually having to manage money, either as a speculative trader or as a hedger, you will have to take very precise views on markets if you want to really do well if you want to perform well, right? So your view is very specific. You don't expect this low of 55 to break, but you expect a move down to around 56.5, 57 from 59.5. So that's still about $3 per barrel. You want to make sure that you hedge yourself for this drop. So you hedge about 10 contracts. You sell 10 contracts. Okay, so your position goes down to net position is now plus 15. Yes. So your view turns out to be correct. The market now drops to 56.5, and you now feel that this is going to now turn around and go back to 62. Right? So if it's going to go back to 62, remember all decisions are based on your views, right? So, and your views are fallible, but you act on your views. So in that case, you don't want to remain, because remember you went short 10 contracts on the hedge book, right? Is everyone following? Yes, you went short 10 contracts at 59.45. So if now it's fallen to 56.5, so you're making $3 per barrel, right? So on 10,000 barrels, you're making $3 each. $3 per barrel. Now you don't want to remain short 10 contracts, because your view is that the market is going to turn around from here and move up to 62. In that case, your 59.45 shorts of 10 contracts will lose money at 62. Yes or no? Yes, Ganotra, you agree?
Yes.
Okay, why is your bag over here? It looks like you're trying to hide what you're doing. You're trying to hide your WhatsApp. Put your bag down so that we can see what you're doing. Alright, so what you do now is this clear? Are you following the logic? You sold 10 contracts at 59.5. Your view was it was going to come to 56.5. It does come there, but now you feel that's going to turn around and go to 62. So now what you're going to do is, because you're running a dynamic hedging program, you are now allowed to unhedge. Initially, when you sold 10 contracts here, you put on a hedge. Now you're going to unhedge, because your view is this is going to go back up. Okay, since your underlying position is long, you would rather be hedging at higher levels, and you don't want to incur a loss on this. So now what you do is you buy back your 10 contracts. You buy back your 10 contracts, which means on the hedge book you do plus 10. What happens to your total position?
0.
25. 25.
Total position is hedge position plus 35. No, first make sure that's why so it's good that we are doing this transaction, the exercise once again. I want to make sure everybody's clear. Okay, although it is already discussed in this at the end of the video yesterday when Saloni is asking this question, I've explained the same thing to her because she was also getting confused, and it's quite natural to get confused because you're hearing these concepts for the first time. So you're just trying to arrange the ideas in your head, so it is quite okay to get confused. There's nothing to be ashamed of, but you just make sure that, like Parul asked a question when she was not clear about something was not making sense to her, so she asked a question, so now it makes sense to her. So this is how you learn. You come to class and you ask questions because everything has to be understood in your way of looking at things. Parul cannot understand it in the way that Shivam understands. Everybody's way of looking at things is different. So you have to ask questions and make it clear according to your own way of thinking. Okay. So who else was saying? You were saying that it's going to be. So the TWS requires a much stronger connection because Google Sheets has not reacted. Okay. So you can see the figures, right? So I sold on the hedge book. That always be clear. The total position is the sum of positions on the underlying book, the passive risk book, plus the hedge book. Okay, or you can think of underlying positions, sum of all underlying positions plus sum of all, or plus minus adjusted by the sum of all positions on the hedge, sum of all hedge positions, sum of all underlying positions plus minus sum of all hedge positions. Yes. That's always the definition of your total position. So you started with 25 underlying position, no hedge. That's why your position was 25. Then you did minus 10 on the hedge book. Okay, let's go back again. Anjum is not convinced. So we changed this also. Now you have an underlying position, starting with an underlying position, no hedge positions. So now you have a slightly bearish view on the oil price, so you sell 10 contracts. So your total position is 25 because hedge position is 0. So you have a slightly negative view, you sell 10 contracts on the hedge book. So your total position is now 15. Yes, plus 15, we can call it plus 15 or okay. So now what you do is, because your short-term view is turned out to be correct, it's come to 56 and a half. Sorry. Now you see this going back to 62. So you would rather hedge at 62 again and not incur a loss on the 59.45 shorts. The 10 contracts at 59.45, if your view is correct and the market goes to 62, they will be showing a loss. You don't want to have that loss. Okay, so you unhedge. Okay, because anyway you were playing only for this move. When you hedged, you were playing only for this move, right? This move has happened. Now your view says it's going back up. So now since you're allowed to run, allowed to do this because you're running a dynamic hedging program based on your risk management policy of the corporation, right? So now what you do is you buy 10 contracts back on the hedge book. So this is a running record of your hedge transactions. This is a running record. Okay. So now the position. Now you see what happens to total position. It was earlier long only 15 contracts, but now it's gone back to 25 contracts. Okay. So one of the reasons why the dynamic hedging program is more risky is you are again opening up the underlying positions on the hedge book. You have increased your risk in that sense. Are you following? Because your risk is already defined by the underlying positions. Okay. So by essentially the risk is defined by the total position. So your total position has again gone up. Remember the goal of hedging, which is there in your notes. What is the goal of hedging? To minimize risk and to bring certainty to your cash flows. It is not to make a profit. The goal of hedging is not to make a profit. So what you have done is actually philosophically contradictory to the hedging principle, which is now you have increased your risk. Can you see that? And now you also see why. When I defined hedgers and speculators, why did I use the word first transaction? Because all transactions need not reduce. So this is also hedging. It's just running a dynamic hedging program. This is also hedging because they are not allowed to make this total position go above 25. Are you following? We will come to that. That is there in your project brief as the golden rule of hedging. We will just briefly cover that today. But is everyone clear? Anjum, are you clear now?
Yes, sir.
Okay. If you remember the total position is hedge position plus underlying position, then you will not get confused. And you have to keep track of all the hedge transactions. So what is the net hedge position? Right now the net hedge position has gone to 0. This is your total of the net hedge position. You can practice on your own and do it. Okay. So this is your net hedge position. Okay, so now, so this is the total of the two goes back. So the first reason why the dynamic hedging program is risky is because you're opening up the risk once again.
Yes.
Okay, what might happen is, we can see why you're saying yes sir, we still have 2.5 minutes. Okay, now one of the things that can happen, 1 minute. The first part is clear.
Yes.
Why is a dynamic hedging program more risky?
Yes.
Because you are periodically increasing the risk. You're increasing the total risk. Whereas in a static hedging program, you never increase the total risk. The total risk always goes down or stays constant. Okay, that's the difference. Everyone clear about that? Static versus dynamic hedging program?
Yes, sir.
Everyone understands? Sukriti, what is the difference? Static versus dynamic hedging? In a static program, you're not allowed to buy back. Once you hedge, that's it. Okay, that part of the position you forget about. Okay, so then therefore you see first point you see why it's more risky, because you are increasing the total position risk. You are increasing the total exposure once again in between. And now what can happen in the market? Because anything can happen. At 56.5, you thought the market is going back to 62. But what might happen is, as soon as you buy back your 10 contracts, the market can collapse to 52. It can be the next price also. I mean, this is a very liquid market, it won't move like that, but you never know what will happen. Okay, so it can collapse. Now what has happened? You opened up your risk, your underlying positions, you increased your underlying positions. Now you have straight away realized a loss of around 56.5, say $4.50 per barrel on your entire underlying position, because you exposed the entire underlying position. Is this clear? So that's why this is much more risky. And the other reason it's risky is because you can actually make losses, right? If you buy at 59.47, let's say if you sell at 59.46, after that the market might go up, which we showed you yesterday. That's the discussion we had. Go back to yesterday's video and see that when Khushbu was asking this question. The example I gave her was that if this goes, you sell it here and then it goes above this high, then you become very bullish. So what, and you see this going to $100, okay, so you decide to eat the loss on this 59.5 to this part. You sold 10 contracts here, you will buy them back at 63. You will realize a loss. Okay, you realize a loss. This loss has to be funded. This is just like your risk capital, as Tarun pointed out. This is just like your risk capital for speculative trading, which we discussed. You have $5 million of risk capital, you have to plan your risk accordingly. This becomes exactly that kind of risk. Are you following?
Yes, sir.
So these are the reasons why a dynamic hedging program is more risky than a static hedging program. But you are being allowed in this project. Please get ready, because we'll have to start the project soon. You better be tracking all these markets. You better get to know what is happening. Go to the CME pages for each of the contracts. There's a lot of fundamental information, technical information. Read it.